Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
All right, at this point I want to sort of turn it back and try to answer all your questions. All right, let's see if I can take some questions. So I'm glad everybody can see the presentation. Let's see. Big crowd today, so I want to thank all of you for attending. Question is if I was wondering if I have a reason to believe that the Aussie against the dollar, again the IC symbol is AUM, was going to move 100 pips or 200 pips, which is about 1 point or 2 points. That's a very good point. Within 2 to 4 days, which one would give you the most bang for my buck? Think of it this way. If you think something's going to happen pretty quickly, you're much better off with a short-dated option. However, if you're wrong, you're going to lose much more money with the short-dated option. So shorter-dated options have more leverage, they have more risk. Longer-dated options have less leverage and less risk. Question, what's the difference between AUM and AUX from the pricing standpoint? Really, it's just the inverse. So if you're looking at the 90 number or the 111, you do the inverse. Essentially, they're going to be the same, but the big difference is that you have to alter your strategy. So if you're bullish on the dollar in AUX, you'd be looking at calls. If you're bullish on the dollar in AUM, you'd be looking at puts. All right, so I hope that helps. Let's see if there are any other questions. Guys, type them in. I'm here to answer your questions. I hope you enjoyed the presentation. This was sort of a change in the plan. We thought that maybe it'd be nice to do sort of a primer. So you got to see how the product was built, a little bit about volatility, a little bit about how options work. All right, can I give you an example on a credit spread? Sure. All right, and I don't have the exact prices, but I might say that a credit spread, if you were, depending on your, let's say that you were looking at the AUX, you might, and you had a view that the dollar might rally. Well, if the dollar might rally, then you'd want to sell some credit put spreads. If you're looking at the AUM and you thought the dollar was going to rally, then you would sell some call spreads. So that's how you would do it. Which ones would you sell? Well, that's up to you. Out-of-the-money options give you a higher probability of success. But again, you're dealing with leverage. You could lose more with those out-of-the-money options. In-the-money options, there's a greater chance that you might lose on these credit spreads. But again, now you have a chance to make actually more money. Looking for a hedge on the pair. If you're looking for a hedge on the pair, then you might want to buy the at-the-money options. You could buy, if you wanted to delta hedge them, you might want to buy, if you had my example of $100,000 worth of risk, you might want to do about 20 contracts if they're at the money, because we know that they're worth, it's worth about 10, roughly, depending on which one you're looking at, and then you would go from there. So that's how, but you'd really have to go back to doing that math on what is the portfolio size, what is the contract worth, and again, the simplest way is to say the Canadian dollar trading at par, so, or parity, if you will, that's worth 10. But if you go to the euro, that contract's worth about 12,500. You're looking at the EUU. If you're looking at EUI, it's worth whatever, 7,000 or 7,800, whatever EUI multiplied by 100 is. So that's how you would do that. You can go back and check it out, go back to the archives, and go back and check out this presentation that I just gave, and you'll be able to, I think, get a better grasp of it. Are there any other questions regarding anything that I went through today, or anything else with currency options? We had a really wild week last week, or even we're still in it, I guess. So how do you decide if you want to be a buyer or seller of options? That's the question. Well, it really depends on what you think the future is going to be. Meaning that if you think that we're going to stay in a volatile market, you're probably going to want to be a buyer of options. If you're not certain on volatility, you might want to be a buyer and a seller, which means a spreader. And if you're pretty certain that the market's going to calm down, you might want to be maybe a credit spreader, but again, with limited risk. You might want to sell on one option that's maybe at the money, and buying out of the money. I mean, there are lots of different ways to trade them. There's no one or there's not one best way to trade. It's really up to each individual investor. I'm going to give everybody another, let's say, minute to type in any other questions that you might have. Okay, see another one. So if you went long the Aussie dollar, that's AUM. And I guess you're saying that it was $100,000. That, again, I don't know what your exposure is, but I think that's what you're saying. And you're looking for a good hedge against it. Well, if you have $100,000 exposure, essentially, if you're long Aussie US and you have $100,000 worth of risk, well, you might want to look at some puts, AUM puts. How many would you need? Well, since our contracts are worth about 9,000, I guess, in the case of the you're going to need at least 11, and you might want to buy more if you wanted to do delta neutral. So you might want to do 15, 16, 17. If it's delta neutral, you might want to do as many as 20. If you're trading delta neutral, the good thing about that, though, is if you're right on, if it starts to move in a volatile fashion, you might want to close out of your dollar exposure, your spot, and then close out of your options, or as the dollar strengthens, you'll be losing money in your spot, but if it falls, if the falls far enough, you're going to have more than ample coverage there because you bought extra. You did it delta neutral, but if the dollar continues to strengthen, you'll have more of a hedge, and you'll be able to close some of that also. So that's if you did it delta neutral or bought extra contracts.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.